Hi, welcome back. If you follow the silver market even a little bit, you already know that most weeks feel pretty routine. A little bit of data comes out, prices wiggle, and life goes on. But every so often, the calendar lines up in a way that almost never happens, where several major economic events land back-to-back in the same week. And when that happens in a market as tightly wound as silver is right now, it can turn an ordinary week into one that traders talk about for months. That is exactly the kind of week we are looking at right now, and today I want to walk you through why this particular stretch of days has so many people in the silver market paying close attention. Let's start with the big picture, because understanding why this week matters means understanding what has been building underneath the silver market for a while now. This is not a story that started this week or even this month. It is the result of trends that have been quietly building for a long time, and this week simply happens to be the moment when several of those trends collide with a dense cluster of economic data. Silver has been trading in a strange kind of tension in 2026. On one side, you have the paper market, meaning the futures and financial contracts that trade in massive volume every day. On the other side, you have the physical market, meaning actual bars and coins that people and institutions want to hold in their hands. For years, those two markets moved together in a fairly predictable way. But lately, that relationship has been stretched, with physical demand pulling harder than the paper market wants to admit. Add to that a supply picture where more silver is being used every year by solar panel manufacturers, electric vehicle makers, and semiconductor producers than is actually being mined out of the ground, and you start to see why this market has been sitting on a coiled spring for quite some time. Now here's what this means for the specific week we are talking about. 4 separate economic events are scheduled to land within just a few days of each other. First, there is the latest Consumer Price Index report, which tells us how fast prices for everyday goods are rising across the country. Second, newly confirmed Federal Reserve Chair Kevin Warsh is scheduled to testify before lawmakers, giving investors their clearest look yet at how he plans to run monetary policy going forward. Third, China is set to release its second quarter GDP figures, offering a window into how the world's largest industrial user of silver is actually performing. And fourth, we get an updated read on consumer sentiment, which captures how everyday Americans feel about their own financial situation and the broader economy. Individually, each of these events would matter on its own. Stacked together in the same week, they create something much bigger than the sum of their parts. Think about it this way. Imagine 4 different rivers, each one flowing steadily on its own, doing its own thing, causing manageable ripples wherever it goes. Now imagine those 4 rivers suddenly converging into the same narrow channel at the same time. That is essentially what is happening with these 4 data points. Markets that are already sensitive to inflation, interest rates, global growth, and consumer confidence are about to receive all 4 signals within a matter of days, and silver, more than almost any other asset, tends to react strongly when multiple currents like these hit it at once. Let's break this down piece by piece, starting with the Consumer Price Index. Inflation data has an outsized effect on precious metals because silver, like gold, is often viewed as a way to preserve purchasing power when the value of the dollar is being eroded. If the CPI report comes in hotter than expected, meaning inflation is running higher than economists predicted, it can push more investors towards silver as a hedge. If it comes in cooler than expected, some investors might temporarily rotate away from metals and back into other assets. Either way, this single report has the power to move silver prices meaningfully within minutes of its release, and that is before we even get to the other 3 events. Now this is important because the second event, Kevin Warsh's testimony, adds a layer of complexity that goes beyond a single data point. Warsh took over as Federal Reserve Chair earlier this year, and the market is still learning how he communicates, what language he uses when discussing inflation, and how he balances pressure from different directions when it comes to interest rate policy. Every word choice in a testimony like this gets picked apart by traders in real time. If his tone suggests a more aggressive stance on interest rates, that can strengthen the dollar and put pressure on precious metals in the short term. If his tone suggests more flexibility, that can do the opposite. The uncertainty itself, simply not knowing exactly what he will say, is part of what creates volatility around events like this. Then there is China's second quarter GDP report, which brings a completely different kind of influence into the mix. China is not just a major economy in a general sense, it is also one of the largest industrial consumers of silver on the planet, using it extensively in electronics, solar panel production, and a wide range of manufacturing processes. When China's economic growth numbers come in strong, it often signals healthy industrial demand for silver going forward. When those numbers disappoint, it can raise questions about whether that demand will hold up. Given how tightly the global silver supply is already stretched, any signal about future industrial demand from a country of China's size carries real weight. And finally, we have the Consumer Sentiment Report, which might sound like the least exciting of the four, but actually plays an important role in tying everything together. This report measures how confident everyday Americans feel about their jobs, their finances, and the broader direction of the economy. When sentiment is weak, it often reflects concerns about inflation, job security, or general economic uncertainty, all of which can nudge investors toward assets like silver that have historically been viewed as a store of value during uncertain times. When sentiment improves, some of that defensive positioning can ease off. Put together with the other three reports, this final piece completes a fairly comprehensive snapshot of where the economy stands, all delivered within the same short window of time. Here's what makes this particular week even more interesting when it comes to silver specifically. Beyond the economic calendar, there is another dynamic quietly playing out underneath the surface, and that has to do with the structure of the futures market itself. On the COMEX exchange, where a huge amount of silver trading takes place, there is a meaningful gap between what is called registered silver, meaning metal that is actually available for delivery, and eligible silver, meaning metal that is sitting in vaults but not necessarily available to satisfy contracts. When that gap narrows and registered inventories stay tight, it raises the stakes for anyone holding a short position, meaning anyone who has bet that silver prices will fall. If prices move sharply higher during a volatile week like this one, some of those short positions can come under pressure to buy back silver quickly to limit their losses, and that buying itself can add fuel to the price move. This is often referred to as a short squeeze, and it is one of the reasons volatile weeks in silver can sometimes produce moves that are larger than the underlying economic data alone would suggest. Let's talk about the emotional side of this for a moment, because numbers and mechanics only tell part of the story. If you are someone who holds silver, whether in physical form or through an investment account, weeks like this one can feel a little unsettling. There is a natural tendency to want certainty, to want to know exactly what is going to happen before it happens, but markets rarely offer that kind of certainty, especially not in a week with this many moving pieces. The healthier approach is usually to understand the mechanics at play, stay informed, and avoid making emotional decisions based on short-term price swings in either direction. Before we go further, if you are finding this kind of breakdown useful, consider subscribing to the channel so you do not miss future updates like this one. We cover these kinds of market-moving events regularly, and having you along for the ride helps this channel keep growing. Now let's get back into it. It is also worth acknowledging that not everyone agrees on how significant this week will actually turn out to be. Some analysts argue that markets have already priced in most of the expected outcomes from these four events, meaning the actual price reaction could end up being more muted than the build-up suggests. Others point out that silver's relatively small market size compared to gold means that even modest surprises in the data can produce outsized price swings, simply because there is less liquidity to absorb sudden shifts in sentiment. Both perspectives have merit, and the truth is that nobody can predict with certainty exactly how these events will play out or how the market will respond in real time. So how should you think about a week like this? Here's a simple mental framework that can help. Instead of trying to predict the exact outcome of each individual report, it can be more useful to think about the range of possible scenarios. In one scenario, the data comes in mixed, meaning some reports lean bullish for silver and others lean bearish, and the result is a choppy, back-and-forth week without a clear directional move. In another scenario, several of the reports align in the same direction, either all supporting higher silver prices or all supporting lower ones, and that alignment creates the kind of momentum that can lead to a sharper move, especially if it interacts with the tight supply conditions we talked about earlier. Thinking in terms of scenarios rather than certainties tends to lead to calmer, more rational decision-making. Looking ahead, there are a few different ways this week could unfold. If inflation data comes in hot, if Warsh's testimony leans cautious on rate cuts, if China's growth numbers disappoint, and if consumer sentiment weakens, you could see a combination of factors that pressure silver in different directions at once, creating genuine uncertainty about the net result. Alternatively, if the data leans more uniformly in one direction, whether that is toward more inflation concern and economic uncertainty, or toward stability and confidence, the price reaction in silver could be more pronounced and easier to interpret after the fact. There is also a middle path, where the reports offer no major surprises at all, and the market simply absorbs the information without much drama. All of these outcomes are genuinely possible, and being aware of that range ahead of time is far more useful than trying to guess which one will happen. It is worth remembering why any of this actually matters to you personally, beyond the headlines and the charts. If you hold any silver, whether as a small part of a diversified portfolio or as a more significant position, weeks like this one are a reminder of how interconnected the economy really is. A testimony in Washington, a GDP report out of Beijing, a sentiment survey of American households, and an inflation report, all feeding into the price of a metal that many people use as a way to protect their savings over the long run. Understanding these connections does not just help you make sense of one particular week, it helps you build a more complete picture of how markets work in general, which is valuable no matter what you decide to do with that information. It is also worth being honest about the risks involved in a week like this. Volatility can cut in both directions, and a market that has the potential to move sharply higher also has the potential to move sharply lower, if the data disappoints or if sentiment shifts unexpectedly. History has shown that markets do not always react the way people expect, even when the setup looks obvious on paper. Sometimes a report that looks bullish on the surface gets overshadowed by a single sentence in a testimony, or a GDP number that looks strong gets dismissed because of underlying details that concern traders more than the headline figure. Nobody should treat a week full of catalysts as a guaranteed setup for one particular outcome. The responsible approach is to stay educated, watch how the market actually responds to each piece of data as it comes out, and make decisions based on your own individual circumstances, timeline, and goals rather than on short-term excitement or fear. That kind of patience tends to serve investors far better over the long run than trying to chase every headline as it crosses the screen. So let's bring this all together. We have 4 major economic events landing within days of each other, each one capable of moving markets on its own, all arriving during a period when the silver market is already dealing with tight physical supply, strong industrial demand, and a meaningful gap between paper contracts and available metal. That combination is what has so many people watching closely right now. Whether this particular week ends up producing a dramatic move or a relatively quiet one, the underlying dynamics we have talked about today, the supply and demand imbalance, the structure of the futures market, and the growing role silver plays in modern technology, are not going away anytime soon. Those forces will continue to shape this market long after this particular week has come and gone. Thanks for spending this time with me today. If this helped you understand what is happening in the silver market a little more clearly, give the video a like, and if you have not already, subscribe so you catch the next update as this story continues to develop. I will see you in the next one.